The 2026 market is shaping up to be a battlefield of volatility, uncertainty, and endless noise. But what if the smartest move isn't chasing some hyped up AI stock? What if it's a boring portfolio of just 3 ETFs designed to weather any storm? Well, today I'm going to break down a simple 3 ETF portfolio built for stability, income, and long-term growth. No stock picking, no market timing, just straightforward plan that we can start right now. If you looked into investing at all, you've probably heard of the classic 3-fund portfolio. It was pioneered by Jack Bogle, the founder of Vanguard. Hope I'm pronouncing his name correctly. And the idea behind it was simple. Own the entire US stock market, own the entire international stock market, and own bonds. Broad diversification, low costs, and set it and forget it. For decades, it worked beautifully, but we're not in that world anymore. Bonds have become a source of confusion for a lot of investors. They are supposed to be the safe part of a portfolio, the thing that holds steady when stocks fall. But 2022 kind of flipped that script. When the Fed raised interest rates aggressively to fight inflation, bond prices kinda got crushed. The Bloomberg US Aggregate Bond Index dropped around 13% that year, one of the worst years in bonds history. Many investors watched their safe holdings fall right alongside their stock. That was not supposed to happen. Here's why. When interest rates rise, new bonds come with higher yields. That makes the existing bonds with lower rates less valuable. So when you're holding a bond fund and the rates keep climbing, the value you're holding drops. And with ongoing uncertainty about inflation, where the rates go from here, that risk hasn't gone away. Now, bonds aren't bad. Yields are better than they have been in years. You can get a 4 to 5% on treasuries today. For very conservative investors or those close to retirement, they will still make plenty of sense. But a lot of people right now are looking for alternatives. They still want the stability and income, they just want it from stocks instead of bonds. The advantage of dividend paying stocks over bonds comes down to growth. A bond pays a fixed rate over a certain amount of time, but a company like Procter & Gamble can raise dividends year after year to keep up in place with inflation. Over time, that growing income stream can be more powerful than a static bond payment. So here's the question. How do we take Bogle's timeless philosophy and update it for 2026? How do we keep the simplicity and diversification, but engineer it for today's challenges in today's market? That's exactly what this portfolio is going to do. Same core idea, global diversification, but reinforced with assets built for resilience and cash flow. And here's something important. If you're worried about the AI bubble, and you probably should be, this portfolio sidesteps it almost entirely. We are not betting on Nvidia or the Magnificent Seven. We are not hoping some AI startup becomes the next trillion-dollar company. Instead, we are going to focus on businesses that make money right now, regardless of what happens with an artificial intelligence. The first ETF is the Invesco S&P 500 Low Volatility ETF, ticker SPLV. This is the defensive anchor of the portfolio. Now, this isn't your typical S&P 500 index. Most index funds just buy all 500 companies weighted by size, which means you end up heavily concentrated in whatever is hot at the moment. Right now, that's a handful of mega cap tech companies. SPLV takes a completely different approach. It screens the entire S&P 500 and pulls out the 100 stocks with the lowest price volatility over the past 12 months. No fancy algorithm, no subjective picks, just a straightforward filter for the most stable companies in the index. So this will naturally tilt the fund towards defensive sectors. You will find heavy weighing in utilities at around about 22%, financials at about 16%, and consumer defense stocks at another 16%. Technology, just 6.5% of the fund. That's a fraction of what you get with the standard S&P 500 index, where tech companies can be 30% or more. The top holdings will tell you the whole entire story about this ETF. So we're talking about companies like Most Energy, WEC Energy Group, Coca-Cola, and Realty Income. These aren't the companies making headlines. They're not promising to revolutionize the world with AI, but they are the ones holding everything else up when everything else is falling apart. So what does this actually mean for your portfolio? Well, when markets drop, high-flying growth stocks usually get hit the hardest. We saw this play out in 2022 when some of the biggest tech names lost 50, 60, even 70% of their value. SPLV won't avoid losses entirely during a downturn, but its goal is to fall less than the broader market. It helps you stay in the game when the panic sets in. Here's a real life example. During the COVID crash in March 2020, the S&P 500 dropped about 34% from peak. SPLV dropped too, but the recovery was smoother for investors who weren't dealing with the gut-wrenching swings of high beta stock. Now, there is a trade-off. In a roaring bull market, SPLV will probably lag lag behind the broader index. When growth stocks are ripping higher, low volatility stocks tend to look boring by comparison. You're giving up some upside in exchange for smoother rides down the road. For anyone worried about how concentrated the market has become, where there's just a handful of companies that drive most of the gains, this is a solid alternative for US exposure. The expense ratio is about 0.25%, which is a reasonable amount for smart beta strategy. Getting a defensive large cap anchor that prioritizes stability over hype. The second ETF is the Vanguard Consumer Staples ETF, ticker VDC. If SPLV is the shock absorber, VDC is the engine that keeps running no matter what you throw at the economy. Consumer staples are products people buy out of necessities. Groceries, soap, toothpaste, toilet paper, medicine. Whether the economy is booming or we're in the middle of a recession, people still need this stuff. You might delay buying a new car or skip that vacation, but you're not going to stop buying food. This fund gives you exposure to the giants of the space. We're talking about Procter & Gamble, Costco, Walmart, Coca-Cola, PepsiCo, Colgate. These are some of the most recognizable brands on the planet, and they've been generating profits for decades. As late as 2025, VDC holds around 108 stocks, but it's heavily weighted towards the top names. Walmart is about 14%, Costco sits at around 13%, and Procter & Gamble at 11%. That's not necessarily a bad thing. These mega consumer staple companies have proven staying power. Now, here's something that matters if you're concerned about the tech concentration and the AI bubble. VDC has exactly 0% allocated to technology stocks. It's 98% consumer defensive. This is as far from AI as you can get while still owning equities. No chips, no software, no speculative bets on which companies will dominate the artificial intelligence race, just companies selling things people use every single day. Here's what makes this sector so special. Because these businesses have incredibly steady cash flows, they can afford to pay reliable dividends, and many of them have been raising these dividends for the last 25, 40, and even 50 consecutive years. Procter & Gamble has increased its dividends for over 65 years straight, Coca-Cola for about over 60 years. These are called dividend aristocrats or dividend kings, and VDC is loaded with them. The current dividend yield on VDC hovers around 2.5%, which isn't going to blow anyone away, but the real story in here is consistency. This is money that shows up in your account quarter after quarter, year after year, regardless of what the stock price is doing. Now, let's talk about why this matters in a downturn. During the 2008 financial crisis, consumer staples were one of the best performing sectors. While banks were collapsing and the broader market was in free fall, companies like Walmart actually gained ground. People still needed to eat. During COVID, same story. Grocery stores and consumer good companies held up far better than the rest of the market. And the expense ratio on VDC is just 0.10%, making it one of the cheapest ways to own this sector. You're paying almost nothing for exposure to some of the best battle-tested companies in existence. Here's the way I'm thinking about it. While some companies are promising future growth may or may not happen, consumer staple companies are delivering real profits today. You're not betting on what might work, you're investing in what is already working and has been working for quite some time. The third and final ETF is the Vanguard International Dividend Appreciation ETF, ticker VIGI. This is what takes a portfolio from good to complete. One of the biggest mistakes investors make is only buying stocks from their home country. If you are an American, it is easy to think that the US market is all you need. And honestly, it's been a great place to invest for the past decade, but putting all your money in one country is risky. Economics move in cycles. What works today might underperform tomorrow. VIGI solves that problem by giving you exposure to the international market and international stocks, but with an important twist. It doesn't just buy any foreign companies, it specifically targets companies that have grown their dividends for the last 7 consecutive years. Think about what actually that requirement filters for. A company that can raise its dividend year after year is sending a clear signal. It's financially healthy. It's generating consistent cash flow. Management is disciplined and they're confident about the future. You're not just getting international exposure, you're getting quality international exposure. As of 2025, VIGI holds nearly 400 stocks across the developed markets like Japan, the UK, Switzerland, Canada, plus emerging markets like like Taiwan and India. The geographic diversification is impressive. No single country dominates this fund, which spreads your risk across multiple economies. Top holdings include names like Royal Bank of Canada, Novartis, Mitsubishi, UFJ Financial Group, Sony, SAP, Roche, and Nestle. These are global powerhouses with operations spanning continents. Now, VIGI does have some technology exposure, around 15% of the fund, but here's the key difference. This isn't Nvidia or the Magnificent Seven. It's companies like SAP, which makes software, and Sony, which is diversified electronics and entertainment conglomerate. These are established businesses with decades of dividend growth, not speculative AI plays trading at 50 times their earnings. Here's something clever about how the index is constructed. It actually removes the top 25% highest yielding stock from consideration. Why, you may ask? Because an unusually high dividend yield is often a warning sign. It might mean that the stock price has crashed or that the dividend is about to be cut. By filtering out these yield traps, VIGI focuses on companies with sustainable growing dividends rather than the ones just looking to be attractive on paper. The expense ratio is around 0.10%, which is remarkable for international exposure. You're getting access to hundreds of quality companies across dozens of countries for literally almost nothing. VIGI ensures your portfolio isn't just defensive, it's globally diversified and positioned to capture growth from the best companies around the world. When the US market hits a rough patch, having international holdings can smooth out the ride. And the dividend growth focus means you're not sacrificing quality for diversification. All right, so we got our three ETFs: SPLV for defense, VDC for an all-weather reliability, VIGI for global dividend growth. Now, let's talk about how to actually use them. The simplest approach is an equal split. Put a third into about each fund. This gives every ETF the same influence and creates a balanced foundation from day one. You're not overweighing any single strategy. Defense, income, and international growth all carry the same importance. From there, it's all about consistency. Pick a schedule, weekly, monthly, or bi-weekly, and invest the same amount every single time. This is called dollar cost averaging, and it takes the emotion out of the equation completely. When prices drop, your regular contribution buys more share. When prices rise, you buy fewer. Over time, it smooths out your average cost and removes the temptation to time the market. About once a year, you should check in and rebalance. Let's say VGI has a great year and grows 40% of your portfolio, while the others have shrunk to about 30% each. You'd sell a little of VIGI and redistribute to SPLV and VDC to get back to your 33% target. So there it is. No complicated formulas, no constant monitoring, no stressing over daily price movements, just a simple framework that you can stick to for years or even decades. This isn't some get-rich-quick scheme. It's a get-rich-for-sure strategy built on patience, discipline, and a framework designed to protect your money while it grows. And unlike chasing the latest AI stock or trying to guess which tech giants will dominate tomorrow, this portfolio is built on something a little more real and something a little more stable. Companies that sell groceries, toothpaste, utilities, keep the lights on, international business with decades of dividend growth. These aren't supposed to be sexy investments, but they're the ones that let you sleep at night. You don't need to be a stock picking genius. You don't need to watch the market every day. You just need a plan you can actually follow. PLV keeps you grounded, VDC keeps you steady, VIGI keeps you global. Together, they will give you a portfolio that is durable, reliable, and built for the long term. That sounds exactly like what you are looking for. Give me a sub so we can keep on building together. And drop a comment. I want to know which one of these three funds you're going to buy or which funds you are buying. And remember, in a world full of noise, the most powerful thing you can have is a simple plan that you can actually stick with. Forget the hype, start building your foundation today.